So you'll see next the all-important disclosure slide. So I'm sure you'll all have a moment to absorb that. And then we'll take a look at what's happened in the market over the last quarter and so far year to date. So what you'll notice here, this looks at a range of different asset classes. If you have a diversified portfolio, you probably have exposure to every one of these different asset classes. And the first thing I'll point out is that on a year-to-date basis, so these bars overall represent what's happened so far in 2024. What you'll see is every single asset class that we track is up. It's a pretty good year, right? And big contrast to 2 years ago, if you remember 2022, when we had stocks across the board were down and bonds across the board were down. So pretty solidly this year, no matter where you're invested, you've seen positive returns. And looking all the way on the left on US stocks, I mean, up 22% so far this year. That is a really extraordinary return for a fairly short period of time, and comes on the heels of very, very strong performance in 2023 as well. But you'll see that strong performance wasn't just in the US. We saw strong stock performance in emerging markets, in other developed markets outside the US. And interestingly, so those like more shaded parts are what the market has done just for the last quarter. So heading into by the middle part of the year, US stocks had been clearly outperforming non-US stocks. And then in Q3, non-US stocks started to take the lead a little bit. On a year-to-date basis, they still haven't caught up, but interesting to kind of see those shifts back and forth. Those blue bars in the middle are fixed income. So, if you recall 2022, as I mentioned, bonds were down. 2023, bonds also lagged. And in the early part of this year, we still didn't see, much return in bond land. But in the third quarter, that started to change. So you'll see high yield has really led the way, up 8% so far this year. And if you look at that measure, the US aggregate, that is a variety of different types of bonds kind of all rolled up together. And you'll see there where we had pretty strong performance in the third quarter, kind of barely or leaving that slightly in negative territory. So in aggregate, bonds are pretty much flat so far this year. With that, let's take a deeper dive into sectors. Same here in that the full bar shows year-to-date returns for 2024, and that shaded piece is just what happened in Q3. So again, almost everything across the board is looking quite positive. All the way on the left, you'll see information technology, and then third from the left, communication services. So these are a lot of household names that you'll be very familiar with. So think like Meta, Amazon, Apple, those are all in those two sectors and have really driven very, very strong performance so far this year. What I find particularly interesting is utilities, where if you look at just that more deeply shaded bar, that is the return for utilities in the first half of the year. Pretty small relative to other sectors, but then you'll see that shaded part, 20% return in Q3 alone, making it one of the strongest sectors so far year to date. So that's been a huge shift from first half of the year into the third quarter. I'll point out energy, which has really lagged overall so far year to date, and we'll talk a little bit about what's been driving that, but very different experience in that part of the market. Focusing on treasury bonds. So it's been very interesting to sort of track what's been happening here. So this is looking at treasury yields across the yield curve, or for treasury bonds of different maturities. So all the way on the left are very, very short-term treasury bills, we would typically call them. And so those tend to be very driven by the Federal Reserve. As you go further out into the curve, those are longer and longer duration bonds. And what you'll see is that yields actually go down as your bonds become longer dated. This is very unusual. Normally, if you're borrowing money for a longer period of time, you're going to expect to pay more, right? Because there's more risk. For a 10-year loan, there's a lot more risk that something will happen 8 years from now and I won't be able to pay that back. So you're going to probably have to pay more for that. over the last 2 years, we've had this very unusual situation where short-term rates are higher than long-term rates. That typically only happens before you have a recession. In this case, we didn't have an official recession during that time period, but we still have been sort of like stuck in what we would call an inverted yield curve. Now, as you can imagine, the Fed is starting to lower interest rates on the short-term side. And so there's some areas on this yield curve that are now positively sloped. So if you look at the 2-year yield, that yield is now below a 10-year yield or a 20-year yield. That's a more normal piece, but we still have that very short term, which the Fed is going to continue to knock down over time. So something to be aware of. And those longer rates, like in that 2-year area, are what has helped bonds perform well, because as yields come down, bond prices go up, and investors tend to benefit from that. So something to be aware of, and something that will continue to shift given Fed rate cuts going forward. All right, with that, let's take a look at where we are in the economy. So we have this dashboard just to go through, the 5 areas of the economy that we spend a lot of time looking at, and to try and rate where we think we are. Because sometimes one area of the economy will be quite strong, while another area will be weak. And certain areas of the economy tend to move much more quickly than other. I grew up in this business with this idea of don't fight the Fed. So the Fed has an outsized impact on what happens in the overall economy and the market. And so that's really why we have monetary policy first. And as you're probably aware, the Federal Reserve had its first interest rate cut in September. So this was after enormous Fed rate increases to try and tamp down inflation over the last couple of years. And so that really started this kind of new cycle of the Fed cutting interest rates. When interest rates come down, that tends to be stimulative of the economy, and that we tend to see economic growth pick up. But it takes a little time. Manufacturing, used to be the backbone of the U.S. economy, has sort of declined in importance for the overall economy, but is still very important. And remarkably, manufacturing has really been in recessionary territory for about 2 years. So very unusual that manufacturing could be under this kind of pressure, but have the rest of the economy sort of make up for it so that the overall economy doesn't slip into recession. We've had a couple of sort of points along the way where it seems like manufacturing is coming back, and then only to have it retreat again. The consumer, this one I would argue we've had a lot of internal debates about, not entirely clear, because we have some conflicting signals. So when we look at consumer balance sheets, right? So how much assets that individuals have relative to how much money they owe and how much income that they're having, those actually look quite good. Consumers don't have a ton of debt on their balance sheet, on their like household balance sheets. The labor market's quite strong, so wages have been pretty good. That said, we have seen credit card delinquencies begin to increase. Now, it makes sense if you think about it. Interest rates have been creeping up, therefore credit card rates have been creeping up. And if you're relying on credit cards a lot to kind of fund some spending, it's going to be that much harder to pay that off. So we started to see more and more people having a hard time paying their credit cards. What's interesting too is that despite kind of the overall health of the consumer, confidence remains quite low. Although this morning we had a really good number where consumers are starting to say that they feel much more comfortable about their financial situation. Housing is another one where, we've had a number of different conflicting data points there, where a lot of folks are sort of stuck in their homes. They have very low fixed mortgage rates and are reluctant to kind of give those up, only to pay, potentially a higher price for another home. So home sales have slowed quite significantly, but home prices have remained pretty buoyant. And in fact, we had a home builder report earlier this morning, last quarter's earnings, which looked disappointing. So they're, again, very interest rate sensitive sector, where you've had some kind of pushes and pulls. Finally, labor, and we'll dig into each of these some more in a moment. But labor, here's where we have extraordinarily strong labor markets but decelerating. So when we look at things like the unemployment rate, it's at a very, very healthy level compared to the last, 50, 60 years worth of data. But the number of jobs available are declining, and so it's starting to tighten. So we've kept that in the neutral territory because of the trajectory of where it's going. All right. So I mentioned, I sort of grew up in this business with the idea of the don't fight the Fed. And what the Fed has told us is that they want to get inflation down to 2%. Our view has been that that's a pretty tough bogey for the Fed to get to. And it's really because of this. So when we look at core consumer prices, that's what this is measuring. This is probably the most quoted inflation measure, but any economist will have many different versions of inflation. And you'll see here, if we look back in time, say from the late 1950s to 1990, you can see spikes in inflation that were quite significant. That was, I think, the oil embargo, back-to-back recessions. Inflation on average over that time was running close to 5%. So that was much, much higher than what we've been used to. If we then look at a closer time period of 1990 to most recently, average inflation was about 2.5%. And the Fed is saying they want even lower than that. They want 2% inflation. Right now, we're running at about 3-ish. 3.5-ish. So, we think that going forward, 2 is actually too tight an inflation measure. Something like 2.5, 3 is a perfectly acceptable inflation rate, but the Fed will have to manage that over time. When we think about that's part of the equation that we use when we think about where Fed funds rate could go going forward. So if you recall, this particular rate, it's the interest rate that is charged overnight. So it's a very, very short-term rate. And that is what the Fed controls. The Fed doesn't control mortgage rates or 10-year treasury yields, anything like that. And if you look in the market, there are certain indicators where you can see where the market collectively is expecting the Fed funds rate to be sometime in the future. So if we look actually back at late last year, the market was expecting that the Fed funds rate would be as low as 3.9%. So that assumed an enormous number, I think it was like 7 to 8 rate cuts over the course of 2024. Well, sure enough, inflation remained stickier earlier this year than what was expected. So by the middle part of the year, the market had started to say, okay, no, the Fed can't cut as much as that. The Fed's only going to be able to cut to 4.9%. So a much more modest Fed rate cutting. Today, those rates have come back down again. Markets expecting 4.4% at the end of the year. So just wanted to highlight how, the market has really gone back and forth about how much rate cutting the Fed has been able to do, and has really sort of downsized the amount of stimulus that the Fed is able to offer with those lower interest rates. Now, part of the reason why the Fed has had to be more cautious is because there are still a fair number of inflationary pressures out there. The economy has been much, much stronger than most people expected at the beginning of the year. Labor market has been quite strong. And here, because of past experience, the Fed is concerned about this potential for resurgence in inflation. Now, this is not a prediction of what we think will happen, but this is an illustration of what could happen and what the Fed is naturally going to be thinking about. So that darker line is looking at consumer price index back in the 60s, 70s, 80s. So again, that's the period that I mentioned where we had the oil embargo, runaway oil prices, back-to-back recessions, very, very difficult time for inflation. And you can see, in about 1975, inflation peaked and came back down quite significantly. But then roll forward a couple of years and inflation started to spike again and actually went even higher that second time. So it's just an illustration of where there are still a fair amount of risks sort of underlying there that the Fed needs to be very cognizant of and not sort of declare victory too soon on its licking of inflation. One of the things that has helped this time around versus that 1980s period is the fact that oil has actually gone down. So this is really quite remarkable when you think about it. So this is looking at oil prices over the last 12 months, and you can see we had a slight uptick, but then oil settled back down again. But think about the context in which this is happening. So you have, I mentioned earlier, a much stronger economy than what was expected. So often oil prices will go up when there's more demand for it, right? And if you have a stronger US economy, you would think there would be more demand for oil, but that has not driven oil prices up. On top of that, you have conflicts in Ukraine and in the Middle East. So often oil will rise in the event of geopolitical uncertainty. We have not seen that. So what's driving oil prices down? Largely weaker economic growth in China, who is a very large consumer of oil. And what we've seen is that China has, over the last bunch of decades, been an enormous driver of global economic growth. That economy has really slowed. The government has trying to sort of bring in some stimulus to try and resuscitate the economy, but so far it's been quite slow. And with that, oil prices have started to come down. So this has really been a helpful lever and sort of like easing some of the pressures on prices and on consumers because they don't have to pay quite so much to fill their gas tanks. All right, another question I get a lot is on gold. So gold, it's up again recently and has just had an extraordinary year so far. And we spent a lot of time looking at, what is driving these higher gold prices. And we looked at a number of different factors, including inflation. So inflation is often used as a reason for why gold is up. But what we found is that going way back in history, it was not a very reliable indicator of gold prices going up. We also looked at geopolitical uncertainty, general uncertainty or risk factors, and there was no consistent driver of what was pushing gold prices up. Then we looked at central bank purchases, and there seems to be a little bit closer correlation between gold prices and central bank purchases. And so what you'll see here is those bars show how much central banks around the world are buying actual gold. And then the medium blue line is showing gold price. And what we found, you can see in 2022 and 23, you had a huge spike up in central banks that were buying gold. And what's interesting is that buying was not happening by like the Federal Reserve, Bank of Japan, European Central Bank. It was happening by all of these much smaller central banks that you don't really hear a lot about. Ones who, are sort of going their own way, who don't really have a huge influence on global economic policy and economy. And these central banks were diversifying into gold for very particular reasons, often for diversification out of the dollar. So many smaller central banks around the world use the US dollar as a store of value. But they didn't want to be solely reliant on the US dollar. So they were looking for other sort of stable assets that they could put in their vaults. And then also for political reasons. So, a lot of smaller countries around the world were sort of uncomfortable having the US government have that much control over these, store of value. So they wanted to find other things to be able to put their money into. And we've seen central banks try to diversify into things like the euro or the renminbi. But there too, I think there hasn't been a huge amount of confidence. So instead, these central banks are defaulting to gold. So just wanted to provide a little bit of perspective there. I mentioned manufacturing and how it's really been interesting and how for a good 2 years, manufacturing has really been in recession. And when I talk with business owners who are in this space, their experience seems pretty consistent with this. So that blue line is showing what's called the ISM Manufacturing Survey. And survey makers go out every month to supply managers who work in manufacturing companies, and they have a series of questions that they ask, and they're pretty straightforward. But one is business better today than it was last month? Are you seeing more new orders? Are you hiring more people? And they put the answers of all of this together. And when you have a number below 50, that suggests that manufacturing activity is declining. When you have a number above 50, that suggests manufacturing activity is increasing. So what you'll see is that that blue line has been running pretty well below 50 for 2 years now. And if you look at other periods when that has happened, you'll notice those gray bars. So when that has happened, typically you've seen the whole economy tip into recession. This time we did not have that. And the reason is really because of that gold line. So that's ISM services. That is a very similar list of questions, but talking to supply managers at services companies. So think things like hairdressers, accountants, something where there's like a person attached to it. And you'll see there that that has remained firmly above 50 throughout this whole, cycle, and has actually been accelerating lately. So the strength in services has been able to offset the weakness in manufacturing. Turning to the consumer then, I mentioned earlier that we've been getting some sometimes conflicting signals from consumers. So this is where the dark line is looking at what we would call nominal retail sales growth. So how many dollars are consumers spending when they go out shopping on a regular basis? The gold line is taking inflation out of the equation. So not, did you spend $100 this year like you did last year, but did you buy 10 widgets instead of 8 last year? So there we're looking at the actual products that were bought and the buying power of the consumer. So what we found is that if you look, that dark line is well above the gold line, and that's where it typically is, but more so over the last couple of years. And while people were going out and spending more dollars, they weren't necessarily buying as much stuff, and that's because of inflation. Inflation had sort of eaten away the buying power for a lot of consumers. So you'll see the nominal retail sales growth stayed in that positive territory. The real retail sales growth was actually negative. So people were spending more money, but they were able to buy less stuff. Interestingly, that has improved over the last couple of months. We've started to see real retail sales begin to increase so that people are now able to go out and actually buy more goods and services with the dollars that they have. So again, this makes sense. As inflation has waned, people's wages are up fairly significantly, and they're able to retain more of those higher wages and be able to put them into retail sales. So when we ask people, how are you feeling? Let's see. Oh, on the next slide, we have that looking at consumer confidence. So here we have like a number of different ways of measuring this, but this is one, University of Michigan. Higher number means people are feeling better about their overall financial situation. Lower number typically happens in recessions. And if you look over the last couple of years, you'll see that consumers were saying they still feel bad about the economy. Typically, that only happens during a recessionary period. And if you look at that low in like 2022, it was actually lower than the last bunch of recessions that we had, which is pretty remarkable. Now, it has started to come back again. We don't have today's number in here, but it was a really nice bounce back up. So consumers are starting to feel a little bit better. But I think the big driver of pessimism about people's personal financial situations and their view of the economy is really because of inflation. Inflation is a really big headwind for folks, but as that's increasingly in the rearview mirror, people are going to feel better and better about the overall economy and their personal financial situation. So I mentioned earlier the Federal Reserve influencing interest rates. So in September, we had the first Fed rate cut that we've had in quite some time. And in fact, typically the Fed increases or decreases interest rates by 1/4 percentage point. In September, the Fed was so concerned about slowing the economy that they actually decreased interest rates by 50 basis points or 0.5 percentage point. That's a lot in one meeting. At the time, one of the biggest misnomers that I saw on the media was this idea like, oh, the Fed's cutting interest rates, therefore mortgage rates are also going to go down. Well, that doesn't necessarily happen. And so at the time, we looked back in the last few Fed rate cutting cycles to look at, okay, if the Fed was decreasing interest rates, what happened to mortgage rates? And what we found is that on average, mortgages were down about 0.5 percentage point, but not always. Sometimes they actually went up. And sure enough, since that September Fed rate cut, mortgage rates are up 60 basis points, or more than half a percentage point. So I just share this because, again, there are a number of anomalies with this cycle, and we can talk about it, but there are a lot of like policy things that could drive higher mortgage rates going forward. So not to be, for instance, putting off buying a house, hoping that mortgage rates are going to be coming down, because I'm not so sure that they are going to be coming down. All right, let's talk about jobs for a moment. So I mentioned earlier that in looking at different parts of the market, there are some that move very quickly, especially when the Fed is changing interest rates. And then there are others that take a long time to move. The labor market is one that typically takes a really long time to move. And so, we saw manufacturing change very quickly. We saw consumers sort of right-size their spending very quickly. But jobs have remained very, very strong. So this is, again, just one way of measuring the labor market, looking at the unemployment rate. So number of people who have said that they're out of work but looking for a job relative to the number of people who are considered in the workforce. And you'll see there's like that slight tick up on the right of that chart. So the unemployment rate, or the number of people who are out of work, has been increasing over the last year or so. But if you compare today's level to all of that history, we're still very, very low. So we're among the lowest unemployment rates that we've had in modern financial history. But the trajectory is for a softer labor market, for fewer jobs being available, for more people being out of work. It's just been taking a good while to be able to see that come through. And one way we're able to sort of anticipate where these numbers are going is by looking at small businesses. So small businesses make up about half of the US economy. And I think they create something like 2/3 of all new jobs that come. So an incredibly important piece of the US economy, but because they're small, they can be quite difficult to actually get information about. So the NFIB is a great source. They, again, have been doing these surveys for many years, and they'll call out to a roster of small businesses and try to get a good sense of what's happening. So this is one of the questions that they ask, which is how many current job openings do you have? And you can see there, peaking in 2021, a clear deceleration in the number of job openings that are available. They also ask how many jobs are you expecting to have, and there too the trajectory has been down. And what's interesting is that when those small business owners are asked to rank their top concerns, historically that top concern is taxes. No surprise. But during this period, like 2020, 21, 22, jobs and hiring the right talent became the top concern of small businesses. That concern has started to drop again in the rankings. So suggesting that small businesses themselves are likely to have fewer hirings going forward, but that's also eased their businesses, right, to not have a labor market that's quite so tight. All right, with that, let's delve into the market and talk about some areas that we think have some interesting opportunities. You'll see here economic data chasing the market. You can try and outrun the economic data, but you're probably not going to get too far. So all of this is, while not perfectly correlated, it is connected. And so one area that we've looked at a lot is the Magnificent Seven. So you've probably heard this name in the popular press. 7 of the largest companies in the country, and ones that have had just enormous earnings power and stock price appreciation over the last 2-ish years. When I'm speaking live in front of clients, I always like to quiz people about who are the Magnificent Seven. But you guys have the crib notes. You can see it down at the bottom. You can see the tickers: Tesla, Google, Meta, NVIDIA, Microsoft, Amazon, Apple. It's a mouthful. But these are all names that you've probably heard a million times. You probably do business with most of them. And in fact, this week we have 5 of those 7 names reporting earnings. So a very big kind of impact on expectations for the market. And so that dotted line on the top just takes all of those 7 names together and projects and shows what the stock price performance has been for those names. The gold line there is the S&P 500. So that's typically the most common way we represent the market. The green line is Russell 2000. So those are small cap names. Back in July, you'll see where those red arrows are. Back in July, if you remember, there was some concern about slowing economic growth, that maybe that growth was slowing faster, in fact, than what the Fed really wanted. And what happens is that the market started to really shift a lot. And the Magnificent Seven sold off, and then you saw investors buying small cap stocks. Now, you'll see that the market sort of righted itself, and the Magnificent Seven started to rebound and have better days ahead. But I think this is a hint of what could happen going forward, and starting to see names outside of the Magnificent Seven start to do well. Because over the last 2 or so years, it's really been the Magnificent Seven who have delivered the bulk of returns in the broad market. And so as we look at kind of comparing large caps to small caps, so the historical performance can really give us some good indications. So as you look at one kind of easy way of showing how concentrated or broad the market is comparing market cap weighted S&P 500 with equal weighted S&P 500. So if you think about it, the way that the S&P 500 is calculated, you have those Magnificent Seven, which are some of the largest stocks in the country. Those have a much bigger impact on what the index does simply because they're so big. So think about this, since we're heading into an election, think about this as the House of Representatives, where every state has larger representation. So states like California, Texas, New York are going to have a big impact on what happens in the House of Representatives because they have much larger representation. Equal weighted, think the Senate, right? Everybody gets the same number of senators, no matter how big or small your state is. Rhode Island gets 2 senators, Texas gets 2 senators. In the S&P 500, that means you have 500 different stocks that all carry the same weight. All right, with that background, if you look at 1995 to current, market cap versus equal weighted has actually outperformed, has performed better by about a full percentage point. Now, if you think about this over, 25, 30-year period, that really adds up over time, right? And that equal weighted has significantly outperformed. Then if we look at just 2023 to the midpoint of 2024, look at how much better the market cap weighted index has done, right? More than double the return of the equal weighted index. Now roll forward to Q3, and what you see is that the equal weighted has pulled ahead by a fair amount. So I want to highlight this in that the experience that we've had with the Magnificent Seven being such a huge driver of the market is very unusual. We have bursts of this, right? It's not that it never happens, but it typically doesn't sustain for a really long period of time. So as we look forward, we would be looking for opportunities outside of those names that have done really, really well. It doesn't mean that the Mag 7 are going to, fall like a stone, but it does mean that there are other areas of the market that have been kind of forgotten, and we want to make sure that we have exposure to those. And ultimately, it really comes down to earnings. So how much are these companies able to put up? And in this sense, there's a really good reason why the Magnificent Seven have done so well, because they're earning a ton of money. They have been, those earnings rebounded in the second quarter of 2023, and they have just continued to put up better and better numbers, and in fact have increased expectations into 2025. So there's really, really good earnings power there. That is a huge difference from 2000, when I started my career at the bursting of the tech bubble, when all of a sudden investors realized that Pets.com had no earnings, right? This is not the case here. The Magnificent Seven have really great earnings. That said, what we start to see, so here we're looking at S&P 500 are the dark bars. This is how much collectively stocks within the S&P 500 are expected to earn, or how much they have earned in the past and how much they're expected to earn in the future. And what you'll see there is that a nice kind of steady increase over the next couple of years. But small caps, those are smaller companies. You can see where 2023 and then into 24, earnings have actually been declining. But then they start to pick up and in fact catch up over time over the next couple of years. So you have these other areas of the market that have been rightfully kind of left behind by investors because their earnings have been slower to increase. But looking forward, those earnings are expected to start to pick up. One thing that's been sort of a challenge to navigate through are valuations, because we can track how much companies are earning, but valuations tell us how much we're paying for those earnings. So it's comparing the stock price to the earnings power of that particular company. When we look at all of this in aggregate, right? So this is taking all of those companies within the S&P 500, market cap weighted, and we look at the price to forward earnings. It's running at about 22 times, which is well above the historical average of 16. And you can see there, we're getting close to the highs that we had during COVID. But here too, when you pull apart different pieces of the market, you have the Magnificent Seven that have a 33 times price to earnings. So they're even more expensive than what this would suggest. And then you have everybody else who's running at about 15 times, so lower than the historical average. So again, depending on where you are in the market, you have very different experiences with valuation. Now, I would also caution that valuation is not a great measure of near-term stock returns. So, I always share that because they help give us a sense of earnings potential or stock price appreciation potential over the next couple of years, but it really has a correlation with, say, over the next 6-12 months. With that, let's take a look on the corporate side. As I mentioned earlier, some of the previous Fed rate increases were having an impact on consumer or credit card delinquencies, right? So as credit card rates have gone up, more people have had a harder time paying off those loans. Well, similarly, in terms of bankruptcy filings, we've seen more companies are having a hard time paying off their loans. Now, that blue bar is year-to-date bankruptcy filings through August. So it can give us a sense of where we've been so far this year compared to previous years. And so far this year, we're seeing the highest bankruptcy filings by year since 2010. Now, it's not spiking, right? It's not a massive increase, but it is creeping higher and does suggest that there's somewhat more stress in the corporate sector. On the right, we look at spreads for high yield. So these are companies that are less mature, that require, are seen as riskier by the market and therefore have to pay more in interest. And the spread compares how much a high yield company is paying versus either a treasury bond or a very mature company. So generally, smaller spreads mean that the market is less worried about that riskier company paying back its loans. What we see here is that spreads are among the lowest that we've seen in many years, telling us that the market is not worried about these companies paying back their loans. So even though we have higher bankruptcies, we see, not a lot of concern in the market. If there were to start to be more concerns about a recession approaching, we would expect this to start to tick up again. I don't know if you've noticed, but there's an election coming up. I think I'm going to guess you guys might feel like I do, and you're very ready to put this behind us. I can't wait. That said, it is a reality. So we've done a lot of work looking at this and looking at how elections impact the market. And I'll keep this brief. If anybody wants to talk about it some more, feel free to put a question in the Q&A. Happy to talk about different policies if you're curious. But I will leave you with this idea that we looked at all presidential election years going back to the 1920s, and then compared it to non-election years going back to that same time period. And then we average them out. And so that's the graph that you see here. That red line is the average over that election year. Over that non-election year. And what you see is that that red line compares to that blue line, which is the election year average, end up in almost exactly the same place by the end of the year. What you tend to see is more volatility, right? So markets bounce around a lot more in an election year than a non-election year. And sure enough, we've seen that over the last couple of months. Beginning in about August, we saw a pretty big tick up in volatility. Still not huge compared to other periods, but more volatile. I would expect over the next week or so, depending on how long it takes for us to know who's going to be in power. I would expect some continued volatility, but then typically what we see is the markets then kind of take off after an election, volatility subsides. And so I will say again what I've said many times over the last nine months, which is that the individual who gets elected and put in the White House actually has very little impact on what happens in the market and the economy, certainly over the medium to long term. So I know there's been a lot of hand wringing around different policies and impact and whatnot. And again, I'm happy to dig into any of these particular areas. But the great sort of wonder and strength of America is the strength of our institutions and the fact that we have a very diversified economy. We have multiple different sort of sources of power within the government. So one individual has very limited impact overall. So but I'll leave you with that when it comes to the election. I will mention one of the sort of issues that will be a challenge to deal with no matter who ends up in the White House is the deficit. And I like to describe the deficit as an American problem, not a party problem. And we did an exercise with this as well, looking back at the deficit. And the fact is, every president since Truman has increased the dollar amount of the deficit. Doesn't matter what party you're in, everybody likes to spend money. Pulling back on that rein, right, and spending less money is much, much harder to do. So just to kind of put it in context, these are projections by the Congressional Budget Office about what the deficit will look like over the next 10 years. So you can see here, very little increase to very little change overall in the deficit. And in fact, it tends to like kind of creep up over the next 10 years. If the tax cuts that Trump put in place a number of years ago, if they expire, if they don't expire, right, and they're all reinitiated, that gold bar is how much the deficit increases then from 2026 on. So just to sort of show how these were very popular tax cuts, and even Biden Harris have not proposed doing away completely with those tax cuts. So, if anything, the trajectory on the deficit is up, and it is quite substantial compared to where we've been historically. So, with that, let me leave you with one more chart, and then we can open it up for questions. This I love ending on because it is such a great reminder. And in fact, these numbers were first put together by Professor Jeremy Siegel, who we're having on a webinar tomorrow. He's always a fascinating guy to talk to. But he went back, he did this work in the 80s, looking back at asset class prices over the last 200 years, and then showed the real returns of those asset classes. So pulled out the impact of inflation. So it was a really unique data set. And what he found is that over time, we have this quote at the bottom, stocks are the most volatile asset class in the short run, but actually the most stable in the long run. And you'll see that red line, that's the average annual return just mapped out over those 200 years. And that has not changed since he first did his work over 40 years ago. What you'll see there, like bonds do an okay job. They're much more stable, don't have the return potential that stocks do, but are still a helpful addition to the portfolio. And then let me just highlight gold, because again, I get a lot of questions about it. And you can see there that there are periods where gold does really well, but has not had the track record that something like stocks have over the last 200 years. So if you're looking for a way to build wealth reliably over time, stocks are the place to do it. All right, with that, let me take a deep breath. Once again, there is a Q&A button down at the bottom. And so feel free to click on that and put in any questions you might have. And I will take a quick sip and then we will get to questions. Okay. So first question on tariffs. So this has been a big focus for the presidential election. What's the potential impact of tariffs on the overall economy? So this is a very good question. And John, if you don't mind, maybe pull up that slide that we have comparing tariffs. So we went through some of the main policy areas of the two candidates and sort of laid them up side by side, talking about taxes, tariffs, and then some other policies. And one thing I will say is that it's kind of remarkable how different these two candidates have presented themselves. It's sort of remarkable sometimes to look through and be like, oh, these are kind of similar. And if you go back to, let me just explain what this is. On the left, we're looking at what tariffs were implemented under a Biden administration. Harris actually hasn't really said much about tariffs. So we just assumed here that tariffs that had been put in place under Biden would be continued. And then what we have on the right are Trump, what we're calling Trump 2.0 tariffs and what he has said on the campaign trail. But going back to when Trump first came into office, he kind of pulled tariffs off the policy shelf, right? If you think about this dusty old library where you have different policies available, tariffs are something that really hadn't been used in a very long time. Trump kind of took them off the shelf, dusted them off, and sort of brought them into the policymaking fold. And when Biden took over, even though there was a lot of resistance to those initial tariffs, what was interesting is that he didn't completely put tariffs back on the shelf. He remade them a little bit and used them a little bit differently than what Trump initially had. But they are still very much part of the discourse. So what I would say in general, and I think this is true for the tax policies that have been proposed as well, Harris in general has taken a sort of much more surgical approach to either tariffs or taxes, whereas Trump has tended to take a more broad sweep. So you'll see here on the left, 25% tariff on steel and aluminum products, increased tariffs on semiconductors. If you go down, tariffs on medical products, needles, personal protective equipment. These are all kind of like leftovers of COVID. And these are like largely national security questions and saying, okay, we need to sort of defend these industries and we need to give our national industries time to build up and not be sort of like competed against, to encourage people to build this functionality in the US. On the Trump side, you'll see 10% baseline tariff on all imports. So again, this is taking a very broad brush and saying we want to disadvantage all non-US made goods. And then 60% tariff on Chinese imports. This, I would argue, is really a political move to disadvantage all Chinese goods. Right. So again, very broad brush. So in general, the impact of tariffs mean higher input costs because there are a lot of US goods that are made with other pieces and parts that are imported from elsewhere. It's not always that you just decide to buy a semiconductor US made versus non-US made. So often you're buying something that's a combination of things that have been made in many different places. Cars are another great example of where you have inputs coming from all over the world. So in general, it'd be very hard for consumers to distinguish between US versus non-US goods, which generally means that overall costs will tend to come up. Here too, I will say, what's said on the campaign trail isn't necessarily what gets implemented. So we have to put a fair discount on this. But tariffs are the one area where you don't need congressional approval to put these on. So I would put a higher likelihood on some of these new tariff proposals getting through than I would on some of the tax proposals. That said, this is an iterative game. I studied politics many years ago, and so this is one of those things where if the U.S. determines tariffs and said, we're going to increase all imported goods by 10%, our trading partners are going to be like, yeah, well, I am too. It becomes this kind of tit for tat. So some of these tariffs, the conversation will begin there; it won't end there. So it's something to keep in mind. Okay, next question. Why is the negative correlation between the stock bond market not valid anymore? Does the national debt play a role? So very interesting question. So normally what we see is that stocks and bonds kind of move differently, which is part of the reason why we love to build portfolios with both of them, because there can be times when the stock market's going down, bonds will hang in and they can kind of protect your portfolio during those times of turbulence. What we found over the last 2 years is both stocks and bonds went down at the same time. That's particularly painful, right? Because there's no part of your portfolio that's sort of saving you. And what that means is that with both stocks and bonds going down at the same time, you have positive correlation. Even though they're going negative, they're going in the same direction, so they're positively correlated. What we've started to see are there have been moments where you've started to see this negative correlation again. And so part of it, if you look back through history, much of that positive correlation or times when both stocks and bonds are moving in the same direction happens when interest rates are increasing. So what we've started to see as the market has incorporated this idea that the Fed is likely to be cutting interest rates, that's allowing stocks and bonds to start to move independently again, or to once again have negative correlation so they have their own paths. And again, from a portfolio construction perspective, that's a better place to be because you're not just relying on one event or scenario to be able to help your portfolio. But part of the question too is the impact of the national debt on that. I'll have to think that through. I can't think of like a direct correlation between the national debt and stock bond correlations, except that when you have a huge amount of national debt, like we do, the US government is going out to the market to sell bonds all the time, right? That's how they borrow money. If they're doing that, they're sort of keeping interest rates high. And that would be a time when it's a little bit harder for bonds to kind of go their own way. So hopefully that helps. We are about to come up on time. So I just want to thank everybody for joining us. It's a great pleasure. I'd love to hear what's top of mind for you guys. These slides are available if you're interested. You want to geek out like everybody here at Kestra Investment Management, you're welcome to. And thank you so much for joining us. Have a good one.